Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about the types of investing and which one may be right for you. But before we do, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. So, for the types of investing, I'm going to throw out the three big types of investing. This is not all inclusive, but these are three general categories that you can think about as far as when you go to invest as an individual or as a family, you can pick one of these three. And the three types are asset allocation, total return investing, or dividend growth investing. And they all have different characteristics, which we're going to talk about in some detail today. Again, this is not all inclusive. There are other types of investments out there. There are certainly a lot of investing strategies. We'll get a little more in detail and a more complicated later. But the first thing you need to figure out as an investor is which one's right for you. How do you want to participate in investing is what we're going to talk about today. So for the first one, asset allocation. This is what you're doing in a 401k, a 403b, the thrift savings plan, if you're with the Department of Defense, any one of those, generally you're doing an asset allocation. So you're going to pick 10% of large cap growth stocks. These can be presented to you in mutual funds. You'll have a menu from, like Fidelity has 50 different things you can choose from. You can do investment bond funds. You can do international bond funds. It's really, when you look at all the different options you have out there, you're going to pick a percentage of each, and that percentage is going to add up to 100%, and that is your allocation. You get exposure to basically all the US sectors generally, or you can choose that, as well as international stock and bond exposure. And this type of investing is fairly conservative, because you have your money spread out. You're ensuring that you have diversification. And if anything, if you have 10 different allocations, well, and they're all mutual funds or index funds, well, each mutual fund or index fund can also own several hundred different things. So really, you should have a basket, if you will, of 1,000+ different investments packaged into what you own. It can be expensive, because instead of going out and buying an individual stock in Apple and Amazon and Facebook, you are actually saying, I just want large baskets of stocks. Well, somebody has to do that. Even if it's completely passive, you're still paying a bunch of people to manage and make sure that that is operating like it should. And even if you buy say a standard total market index that includes the NASDAQ and the Dow Jones and the S&P 500. Well, stocks go in and out of those all the time. And when stocks move in and out of those, of course, these mutual fund managers and index fund managers have to go in and now adjust all these funds. So that's what's going on. So to you, it's passive. However, it's still active, because there's certain criteria to be in all these funds. And like with investment grade bonds fund, as soon as a bond is downgraded, the fund manager can't hold it, so the fund manager has to sell it. So for those that are seeking totally passive investing, it's not as passive as you think. It's passive to you for sure, because generally how it works is you set an allocation when you start working someplace, or once a year or once a decade, or whenever it is you think to look at it. You set your allocation and then you let that go, and you don't worry about it. So it can be good from a stress-free kind of situation of it's just on there. It's generally conservative because it's spread out, and it's not really focused on trying to make the most or lose the least, which we'll talk about later. It's really just, I want to participate, and I want to participate in mass. You're going to pay fees every year, not only to the fund, your 401k administrator, but also each mutual fund or index fund that you pick has a fee associated with it. Even if you put it all into a life cycle fund, that life cycle fund's taking a fee as well. So it's just a little bit more expensive. And it's often, if you saw Wolf on Wall Street and you heard the Ferris wheel analogy, and again, it paints the industry in a very low light, but this is part of that. Your money goes on the Ferris wheel. While you're in the workforce, it stays there. You don't ever withdraw from it. You just add more to it. It stays on the Ferris wheel for 20, 30, 40 years. And at the end, it is what it is. And that's what I call it. The is what it is. It is what it is investing, because you don't know what you own. You have no input on what you own. You don't care what you own. And at the end of it, you get what you get. So some people are very attracted to this because they've heard that any attempt at active money management is not going to outpace the averages. And I chuckle when I hear that for two reasons. The first is, well, of course, it'll everybody can't underperform the average, right? I mean, that's just like, that's math. But from a perspective, this is this theory that's out there, and it's literally been burned into the minds of, I would say, almost everyone over 30, is you have to index because you can never beat it on your own. It's the finance industry. It's a mass marketing scheme that's been going on, and it's been disproven several times by PhD level studies that nobody reads. I get that, because they're not paid millions of dollars to put it in front of your face on CNBC and Fox and CNN, but it's a big marketing scheme of, we, the finance industry, are smart. You, the consumer, are dumb. So therefore you need to hand over all your money and have no input into it whatsoever. And we, the big financial institutions, you can't beat the averages. So therefore we're going to own everything. Well, you know how hard it is for them to just buy everything? It's not. It takes like 2 seconds. And do they have to answer for their skill when the market goes up and down? No. They go, well, it is what it is. So they have no culpability in their performance. It doesn't take them any time to do it. So it's very attractive for a lot of people in the money management business to sell you on this concept, because it's very lucrative for them. And they can't be wrong, because it just is what it is. So if it's your thing, do it. If it helps you sleep at night, just handing your money over it, that's fantastic. And you don't want to be involved, that's okay. Everybody is different. However, it is certainly a hands-off. It's an interesting, I challenge you to think of one other pursuit in your life. And you're generally, if you're listening to a podcast, you're kind of a type A person anyway, lifelong student, likes to learn, likes to take in information and process it and think for yourself. What other endeavor in your life have you embarked upon to where you said, I'm so happy if I can get a C-? Yeah. Hopefully not marriage, hopefully not your career. So you get people that are generally top 10%ers in everything they do in life. But yeah, when it comes to investing, they'll go, I willingly, knowingly, and I want the C-. It's kind of insane. But, and I say C- because it's not just the average, it's minus their fees. So even an S&P 500 fund cannot technically beat the S&P 500 any day, month, year, decade in existence, because it is that with some subtract out of it. So consider that. So that's the first one, is asset allocation. It sounds like I'm hating on it. I'm not. It's right for most people to just put your money in and not be involved. Me personally, that's not me. I would not sleep a wink if my money was being invested that way, because I do kind of actually want to know what I own, and I care about it, and I'm interested in getting the most returns I can out of my money. Kind of like the way I've approached every other endeavor I've had in life. So the first one was asset allocation. That's what we just talked about. Now the second one's total return investing. And of course, the last one's dividend growth investing. So just to recap there, so we'll talk about the second one now, total return investing. Now this is active. There's more active. You can get crazy active, which I don't recommend, but at least a little bit active enough to know what you own, and active enough to know when it's time to not own something anymore. Maybe airlines or cruise lines going into COVID, a pandemic, that's not rocket science right there, right? So there's times to casinos, another one, probably need to move out of that stuff. And there's times to move back in. Some people, again, like I said, they say it can't be done. Okay, it's done a lot, and it's done by a lot of people a lot. And it's funny because when you go into the industry, the industry almost tries to brainwash you into just give up on that, just invest for the masses. Because if you give up on trying to outperform the market, what you can do as an advisor is now all that time and effort that you're spending on actually like being a good investor, now you can get rid of that and turn it into just marketing to the masses of you're dumb, we're smart, hand over your money and let Vanguard just put in an index for you. And they can make a ton of money that way. So anyhow, back to total return investing. You can, with total, it doesn't matter whether you are, I generally talk about 5 different levels of risk tolerance. You have your conservative, your moderately conservative, your moderate, you're moderately aggressive, and aggressive. You can get into shades of gray in there, but as a whole, that's a pretty good framework to hang that on. And no matter where you are within that, you can be active to put together a portfolio to, even if you are conservative, you can at least get more than, you can achieve more than you can actively than you can passively. And you can own certain things that you want to be a part of and you want to be a part owner of, which is, again, owning an individual stock. So in total return investing, generally you get away from the funds unless you need them for a specific thing, and I'll talk about that in a minute, and you get into the individual stocks and bonds, and you construct portfolios, and this takes time, expertise, of course, time, effort, and expertise, if I didn't say that correct, to put these things together so they are optimized towards a risk tolerance. But once they are, they're very efficient. When you think of buying a stock of Apple in 2020 and selling that, which cost you $0, and you hold it for 20 years, and maybe you sell it either never, and it passes on to an heir stepped up, yeah, and you live off the dividends the whole time, yeah, that's kind of nice. But if you do sell it down the road, it costs $0 to sell it. So you talk about efficient, you've held that for 20 years and you've never paid a dime. Versus a fund that holds all the individual stocks that you could own on your own, but you pay a fee every year to do that. So, a lot more efficient if you get into total return investing. And you're really looking at how can I put my time, energy, and expertise to work to make more money than I would if I didn't do that. And like I said, the masses will try to tell you that it can't be done. It's done all the time. It's almost insane. But if that's for you, you're going to create a stock and bond mix, and with some funds in there, some index funds, and on an occasionally a mutual fund. But for your funds, basically, you're going to pick, or for your stocks and bonds, you're going to pick best of breed, investment grade type stuff, not crazy speculative things, but names that when you think of Amazon and Apple and Facebook, Home Depot. Those are names that you can get the, hold for 20 years and get the thousands of % of return on, right? Like if you went back to the 80s and owned Microsoft, people think that active takes a lot of time. Well, it takes a lot of time to figure out what to buy, but once you buy it, you're actually trying to hold it unless your thesis changes. So don't buy something that you don't have a thesis for. But once you do have a thesis for it, you buy it and you hold it till the thesis change. Apple. You have basically a luxury company with expensive, high margin products that are fairly addictive and considered must have. Okay, that can change someday. I don't know when that is, but if it does change and something outpaces it, then that's fine. If you think maybe back in the day for clothing apparel, Adidas was pretty strong for a long time. Lululemon came along, basically outpaced everybody in the field. Their stuff's more expensive, and it's a must-have kind of product, and of course the stock price has followed that. So if you were in Adidas, at some point you had to give up on your thesis and go, no, actually Lululemon's better. So it's that sort of thinking. Again, it does take involvement, or you pay a manager who's involved to do it, but that way you can set yourself up for outpacing the market. And as a money manager, you can't ever just look at your client and say, I guarantee you I can, but you can say in the past I have, and I have several times. But there will be times like in 2018 when you could be outpacing the market as a money manager for the year, and in December the market dropped when the Fed was raising rates, and it dropped about 20%. Well, Apple, who's got a beta greater than 1, actually dove, so somebody could end up underperforming in 2018. But that same Apple stock then not only outperformed, but about doubled the market performance in 2019. So again, if you're using arbitrary like calendar dates like a year versus the total life of your portfolio, then it can make a huge difference. So just something to think about. And that's total return investing. And really the philosophy there is you're trying to make the most, just like you are out of your career, your family, everything else you're involved, your hobbies, everything else you're involved with, you're trying to do your best, make the most. So I would say that is a natural for a lot of those types of people. And the last one we'll talk about, so first we talked about asset allocation. It is what it is. Then you have total return investing, which is investing to make the most. And then the last one we'll talk about is dividend growth investing, which I like to say is more focused on losing the least. So when I say that, you construct a portfolio with dividend growth stocks, meaning they have big dividends, generally that 4 to 5% or more potentially. If you get up towards 9 or 10%, now you're buying some risk there, because what company can generally kick off that level of dividend and still grow? You're right, none over the long term, right? So that it's either a temporary thing until they cut the dividend, or they grow enough to where that dividend now shrinks. But either way, targeting that 4 to 5% in dividend income, and dividend growth means they have a track record of increasing that dividend over time in both up and down markets. Now, not many can. So when you're stressed, like we are right now in a COVID-19 situation, the mark dropped 35% in basically a month in March. Some companies had to cut their dividends. Well, that wouldn't qualify as dividend growth. But we're talking about companies that can not only maintain their dividend through times of stress like this, or 2007 through 2009, same thing. They either maintain their current dividend, and as soon as it was, the all clear was sounded, then they started raising their dividends again. Those are the companies you want to be in. These are your older names, your AT&T, your Visa, your MasterCard. You're not buying these names because the stock's going to double anytime soon. And in fact, it may not double at all. It may just sit there and pay your dividend out, which when you're doing it as a dividend growth investor, you're okay with that. You've said, I am okay with that up front because I really don't want to lose money, but you can in total return investing. If the market goes down, I mean, your portfolio is going to swing right with it. And that's part of outperformance over time in total return investing. Well, dividend growth investing, you will always underperform, not always, you will almost always underperform the market, because you are not holding the names that carry the market higher. You're not holding an Apple or an Amazon or a Facebook or a Home Depot that I've talked about. You're going into stocks, the Visa, MasterCard, Verizon, AT&T type names that just don't have that upside. They've grown so much, and that's how they got this big dividend, is they grew so much into these big companies that now they pay off this huge dividend because they're not really growing a lot anymore. The names that are growing don't pay big dividends or dividends at all, because they have other use for their money. Instead of paying it out to investors, they want to use it for growth. So just realize that if you get into dividend growth investing and you can't go to cocktail parties and slap high fives about the 30% return you got last year, because you probably didn't. You probably got a 5 to 6% return, which is what it's designed to deliver. So who is that right for is a good question. Well, that's right for people that are conservative by nature. Absolutely. Yeah. If you want, it's kind of, if you use the baseball or softball analogy, it's the hitting singles, not home runs. And if that's all you want, then hit your singles. And we all know that if you hit enough singles over a game, then you're going to win. You're going to win in the big game of investing, if you will. But you won't really have that home run, and that's okay for the people that do dividend growth investing. So it's either right for the conservative going in that are primarily buy and hold, and if the market's down, that's okay. They're getting paid these large dividends, which will then in turn be invested right into the same company that paid them the dividend. So what you end up having is you're doing an accumulation. You're a gatherer instead of a hunter. Hunter is more total return investing. Gatherer is the dividend growth investing, where it's just, I'm scooping it up and I'm putting it in the basket, and I know that basket's going to grow over time. And I like that mentality. I don't like taking something out of the basket and having to put something else in, because that involves some analysis on my part, or if I don't have that analysis, it involves guesswork on my part to figure out what to do. So I'm just going to buy these big companies that pay these big dividends. I'm going to stuff them all in the basket. I know that's going to grow over time. And at some point, I can take the dividends and actually live off them, which is the point of all of this, in retirement, or not in retirement, whenever you want to take the money out from dividends, you can. So it's more of a wealth creation and preservation sort of thing. So you're creating wealth, I say, instead of riches, because once you buy something, you're generally holding it for decades, and it's paying you, if you think of a stock that pays you a 5% dividend, well, even without considering compound interest or anything, if you hold it for 20 years, it's paid for itself, right? 5 times 20 is 100%. So you've got more out of the stock than you ever put in it. Yeah, so everything's gravy at that point. So a lot of people are very attracted to that. If that is you, then you're more of the gatherer type person, and you like that, and you can end up with all kinds of companies that way that are paying dividend money, and you just like seeing the income. So if you are a dividend growth investor, an option strategy, which options are not right for everybody, they carry another level of risk. You need to go in and sign a contract. If you use options, you have to fill out a separate form with your brokerage to be able to do so. But you can use a covered call strategy layered on top of all these dividend growth companies, to then get another % or 2 per year fairly easily of income by selling covered calls above your positions. So it's a great way to get a lot of money coming in the door. So as a recap, again, asset allocation, a lot of us do this in our 20s and 30s. You simply just feed the beast. The beast will go do its own thing. You either check up on it or you don't. It doesn't matter, because you don't know what you own. And mutual funds only reprice at the end of the day, so you don't even need to check your phone in the middle of the day to see how your investments are doing, because it doesn't matter. So remember to check it once a year, or 5 years, or a decade, or whatever. So that's asset allocation. We have total return investing, where you're trying to make the most, where you're applying your time, energy, and expertise to try to get the most out of your investments. And then dividend growth investing is, again, that capital preservation, to try to make sure your money lasts, or you accumulate the stocks over time and never really sell any of them. So with that, thank you so much for listening. Please reach out through OTOTnow.com with any questions or comments. And thanks again for listening today. And here's to you fighting the good fight every day to be on time, on target with your financial goals.